other quiz, 10, 11. What was screen 4?
Screen 4? Absolutely. So quiz 10 and 11, numbers 3 and 4 we're doing from this semester. Okay. 3 is Smith Company purchased 2,000 shares of its own common stock for $8. If it's bought, so on March 1st, what do you want to do for the entry? I bought my own stock. I can't have an investment in myself, so what I'm doing is I'm buying back my own stock, so I've got to have a reduction of equity, but I'm not retiring the stock yet. I'm keeping it, right? So I might give it to employees as a bonus, or I might sell it to somebody, right? Sell it again, not market. So what do we call this stuff?
Treasury stock?
Yeah, which is what kind of an account? Equity with a debit?
Yeah.
Which is contra equity, right? The normal? And that would be $16,000. Everybody agree with that?
Mm-hmm.
What did I give them?
Cash.
Cash. Fantastic. $16,000? Happy, aren't we? Okay, so that one's, we got March 1st. So then at June 20th, it says we sold 900 shares for $9. Yeah, I'm going to make $1 a share when I sell them, aren't I?
Yeah.
But can I have gains and losses on my own stock? Of course not. What will I have? If I sold it for more than I bought it for, I'll have more additional paid-in capital. Think of it this way. You bought the old owner out for $8. You issued to a new owner for $9, right? You got one more paid-in capital. That's all per share. Okay, so that was 900 shares at 9. What's that, 8,100? Debit cash, right? Did you get cash?
Yeah.
Remember when that used to be hard? Yeah. Anyway, but yeah, you got that much cash. Okay, 9 times 9. Okay, and then what are we going to do? We put them into treasury stock at how much? And do this, right? Treasury stock. It's not an asset. It's a contra equity, right? So we put 16,000 in here. If I sold, and that was for 2,000 shares. If I sold 900 of them, what should I take out? I put them in at 8. I better take them out at 8, right? So how about $908? You guys agree with that?
Yeah.
Okay, that's all we did. So that extra $1 a share, or $900, must be what? More contributed capital. And we call that additional paid-in capital. Okay? Or maybe additional paid-in capital in general. Got it?
Mm-hmm.
Okay, and then it says that August 5th, we sold 1,000 shares, right? For $7. So these we're losing $1 on, aren't we? But you can't lose money. All you can do is use up your additional paid-in capital from treasury stock, and then what? You must be given some of your retained earnings to entice the new owners to come in, I guess, right? So what would that be? Debit cash for how much? Okay? All right, so we got $7,000 there. Okay? 1,007. How much do I want to take out of treasury stock? There's 1,000 at $8 a share, was it?
Would be 8,000.
8,000. Okay, so treasury stock. Going to get credited for 8,000, isn't it? Okay, so now what I've got is additional paid-in capital on treasury stock. We put how much in there? 900. See that? And how much do we have left in treasury stock now? 800, which represents what? There's 100 shares left at $8, right? So I want to keep that number there, don't I? But this 900 doesn't exist anymore. Why? Because I just lost economically 1,000, right? So I'm going to have a debit for $900 to additional paid-in capital. See, I can get rid of it. It'll make it 0. Additional paid-in capital. Treasury stock. Got it? So it goes to 0. It can't go more than 0. I need another $100 debit. What does that have to go to? I have no choice. Where does it go? Retained earnings. That's it. Not too bad, huh?
I retained earnings for 100 is the 100 that we've lost.
Well, economically lost. We don't call it a loss. We just take retained earnings out. You don't put it on your income statement as a loss.
Okay.
Actually, we lost 1,000, but 900 was an additional paid-in capital, right? So I can take it out because I already had a transaction. If I didn't have a balance in, if that had been the first sale, It would have been retained for the whole thing. Got it. It's only because I had a balance in additional paid capital I could do that. Okay. Good. Not too bad. That's what you say. Okay. Number 4. Parent company's equity structure is as follows: common stock $1 a par, $6 market value, 1 million shares authorized, 700,000 shares issued, 60,000 shares treasury stock. This was maybe a mean problem because we didn't do it in class, but it was assigned, and it was also on the quiz, wasn't it? Maybe it wasn't on the quiz either. Maybe it's just I really suggested you take a look at this. Anyway, and I intended to get to it in class, but that's okay. So now, what do you think, guys? What am I going to do? What's the deal here? These are a stock dividend, right? If it's large or it's small is what matters. And I talked about it in generalities, but I don't think we worked through an example. So what do I mean with a stock dividend? I'm giving people stock. Talk about a lot. I'm giving people stock instead of cash because they don't have any cash. If I give them stock, what's the benefit to them?
Stock's worth more than cash.
Maybe. But I don't have cash. They'd rather have the cash than buy stock if they felt like it, right? But what's the deal? I don't have the cash. I give them something. What if I do $1 a share every year dividend? Well, they got more shares now. They get more dividend. Got the idea? If you always do the same dividend every quarter or every year or whatever. So maybe it's good to have more shares. Okay. The other thing that might happen is when we issue the dividend, maybe the market price won't come down enough, right, to adjust for the new shares that are out there, and the company actually does go up in value, right? So they gain some real value. If I owned 10% of the company before and it was worth $1 million, I might own 10% of the company now and it's worth $1,050,000 or something. So I did get a dividend then, didn't I? Right? So that could happen. So what we think is if it's a big dividend, right, it probably is going to fully adjust, right? The market price will come down for it, right? So we're going to just record them at par. So on the large ones, they go at par. We assume they were worth par value, okay? And if they're small, we assume that they go for market value, which is really nice, right? If it's real. So what I did was I gave you, what was this one, a 2% dividend, the small one? Yeah. And the large one, I say 30%. What's the cutoff? 20 to 25%. Judgment call. I think it's a lot less than that, personally, because I think the market will adjust. If you flood the market with 20% more shares, it's going to know. Price is going to go. What if you only put out 2%? Maybe not fully. That makes sense? I don't know. So, all right. So how would we record each of these? Both of them are going to be debit retained earnings, aren't they? Of course. Dividends are debit retained earnings, aren't they? Or dividend, which is a temporary equity account, close to retained earnings, right? Okay, and then what we're going to do is we are going to issue common stock in both cases, aren't we? Okay? But in the case of the small one, I'm going to record them at market value. And how do you record your common stock? At par value. So what do you have? If I were issuing the stock for cash, what would you do? You debit cash, credit common stock, or credit what for the amount above par? Additional paid capital, common stock. Wouldn't you do that? Yeah, that's what would happen, wouldn't it? Right? So that's all we're going to do. Okay? So that is all we're going to do. All right, so here we go. The large one, let's do the large one first. That's what they had first. 30%. This is it. Okay, so at 30%, how many shares are there? Now be careful. It's $1 par, right? The par is $1. Market value is $6, right? How much additional paid capital are we going to have in every share? $5 again. 1 million are authorized, 700,000 are issued. So how many are not issued? 300,000. Are you going to give dividends to those 300,000? Eat yourself. They're not going to eat yourself. Okay. And then 60,000 of treasury stock. Who's holding those? You. So you're not going to give yourself dividends on those either. Got it? So what's 1 million less 600 less million, less 300, 700, it says 700, less 60 is how much?
It's
640,000, what do we call that? They're out there, so they are outstanding. There you go. That's outstanding shares, right? Number of shares outstanding. 700 have been issued, 300 not an issue, we don't worry about those. 700 have been issued, and then 60 have been bought back as treasury stock. So 640 are out there, right? Good? Okay? So, anyway, 640,000 shares are out there. What would you do? Yeah, for the large one, it's 30%. For the small one, it's 20%. Got it? Or 2%, I'm sorry, 2%. What's 640 times 30%? 192,000 shares. And we're going to record them at par because it's large, right? We think the market value is not going to, it's not going to hold. It's going to go down, right? By virtue of these being out there. So how much is the par? Okay, so it's 192,000, and you've got your journal. That's all there is to it. Debit, retained earnings, credit, common stock. Got it? 92,000. Okay, now what if it's a small one? Small one would be what? Same 640,000 shares, right?
Except you're times it by 2, so
You got it. Times 2%.
you're going to times
By 6.
or by 6, yeah.
6. Market price. So what's 2% of 640? X. Shares. That's your dividend. Times the market value, which is how much? $6. How much is that? 76.8. So that's how much the dividend is. But we're going to record them at par. So I'm going to debit retained earnings 76.8. But the common stock itself is recorded at par. How much is that? 12,800 shares times $1, right? That's good? $12,800. What does the other $5 go to? Yeah. What's $5 times 12,008? 64,000? It is, isn't it? Yeah. Journal entry balance and stuff. You guys good? Too bad. Let's just remember to do them at market value if it's small, par if they're large.
And if the cutoff is
20 to 25%, and I'll always stay real low.
Okay.
1, 2, 3, right? On a large one, I'll go 30, 35. Okay. Then we got a stock split on the last one. Now the thing with the stock split, all you had to do was say no entry. But I might give you a different kind of problem. So let's do it this way. Why do you have to say no entry? Because there's no entry because nothing happened. You just have more shares, but you have lower par value and lower market value, right? But let's take this example that they have here. So C is no entry, right? Okay. C, no entry is all you had to say. No entry, right? You missed that. Okay. So what do? Let's say we have authorized. How many do we have authorized? 1 million?
Yeah.
So I give problems like this a lot. Issued? 700,000 limit. Unissued, obviously, then. 1 million less 700 is 300, right? Treasury stock. What was it? Outstanding. And 640, 700 less than 60, right? Whoops. 640. Okay. Right. That's good. Then, what else do we need? Let's see, the par is how much? $1. And the market value? And per share. So $6, was it? Okay. Now they're doing a 10-for-1 split. There's going to be no journal entry for this because I'm not going to change the amount that I have in common stock or additional paid-in capital. How much do I have in the account of common stock right now?
Since it is a mistake, shouldn't unissued be 300, not 30?
Yes. I said it right, I hope. 1,000,000 less 700 is 300. Okay, I hope I said it right. Okay, and then, yeah, and then 700 less 60. Thank you. Okay, so why is there no journal entry? Because the issued shares times $1, that 700,000 is in that account. Everybody agree with that? And then whatever common treasury stock is in that account, right? Whatever they paid for is in that account. So now what do? Yes, you got it. So this is now, let's do a 10-to-1 split. Take everything times 10 except for what? Yeah, and what's going to happen to those if there's 10 times as many shares? Divide it. There'll be 1/10 as much. Exactly right. You got it, right? It makes sense, doesn't it? Okay? So they do a 10 for 1, it says. So you have 10 times as many. It was 1,000,000. How many are there now? So you get all the shares back that are anywhere, right? And give people 10 for every one. Get all of them back. Give them 10 for every one. That's all there is to it. So how many will be issued then? It's 7,000,000, right? 10 times as much. How many will be unissued? 10 less 7 is 3,000,000, which of course is exactly the same thing as 300,000 times 10, isn't it? You guys good? Okay, how much treasury stock will there be now? 600,000. By the way, what if they bought the treasury stock for $10 a share? Now what would they have? They'd have 10 times as many shares, and the treasury stock would be now at what? $1 a share. There's no journaling for that either, right? Got it? Whatever it is, it is. But of course, per share, it's now 1/10 as much because there's 10 times as many shares, where it's just like a par. Outstanding, it's going to be 7,000,000 less 600,000. Is that right? Which is 6,400,000, which of course is 10 times 640, isn't it? And what do you want to do to that par? What do you want it to be now? Was $1 per share. This was $6 per share. What's it going to be now? 10 cents per share, 1/10. Make sense? So what's 10 cents times 7,000,000? It's 700,000. What'd you have before? 700,000. Look at that, you guys. It's exactly the same, isn't it? Why do you need no journal entry? Because you're not changing the dollar amount. So no entry. Okay? But what do you think will probably happen? We don't know what's going to happen to market value because there's so many things happening, right? We hope if we do a 10-to-1 split, people like our stock better because it's not so expensive, right? So if it's selling for 150 a share and you do a 10-for-1 split, now they can get it for 15. Maybe people buy shares more. Maybe it'll drive the price up. I don't know. Maybe. Okay? But maybe it will. That it's easier to trade our stock. If you never split it, then the stock is also expensive. People will hesitate to buy it. They don't have enough money to buy shares. So what do we do with this thing? What would you think it probably will go down to? There are still 640,000 shares out there, right? They were selling for $6 a share. I bet it goes down around 60 cents. Approximately 60 cents. What do you guys think? Because 60 cents times 6,400,000 shares is the same thing as $6 times 640,000 shares. I think the company's going to be worth about the same amount, don't you? Got it. Not too bad. Boy, we finished the quiz, dude. That's good. And on the first hour today, we did the bottom, right?
Yeah.
And then we did what did we do? Oh, we did ratios in the second hour, didn't we?
Yeah, I'm not any ratio.
And then we talked about the ones that are on the test. And then we did a couple problems, too, I think. A couple questions from one of the quizzes, maybe, was it? Anyway, so we can either do things from the test or we can do cash flow, or we can do a cash flow. Is that worthwhile?
We did a cash flow from the quiz.
Yeah. You know those two that I handed out to you guys too? You can work those again. It's been a while since you did them, right? Work through those again, and then work through the one on the quiz. 3's plenty, if you crank through them. Let's do this Allied Products that's on the quiz then, huh? It's a big problem, but it's a lot of the work too. There are so many videos you can watch now. Huh? I mean, so Mostly this is gonna be crank through problems on your own. And when you get to something I'm really confused, then go make me find the video and watch it. But I wouldn't, you know, I wouldn't watch things I already know. That is pretty tough. Just crank through it as well. All right. So let's do number 4 from quiz 12 in appendix E, and we're doing a cash flow statement. Okay. So let's think about how to do this. You guys walk me through it. What do I need to do?
Allied products.
Yeah, right. Allied products. So spell out their name nicely, right? Of course. I don't care here, but in real life it's supposed to be perfect. Okay, and then what? Statement of cash flows or cash flow statement. Then for a year ended, because we start with the beginning cash and work our way down to the ending cash, right? 12/31, I guess, 2002. So you can write that out real pretty, but okay. Then what? 3 sections. Operations. Go down half the page. Give myself a bunch of room. Investing. Cash flow from investing activities, whatever. Okay. Down at the bottom, we have what? Beginning cash and ending cash at the end. And before that, though, what would I have? The change in cash, right? Okay, so what is that? To get that change in cash, beginning cash, ending cash. Okay, this is going to be change in cash, either increase or decrease. So let's look at the cash. What happened to it? Up or down?
Down.
So you would have written decrease in cash. How much you go down by? 18,000. Put brackets around it, right? We don't need the zeros, do we? And what you could do is do that and then put up here in thousands. Like it? That's what you do in a real statement, okay? 18, so in millions or thousands or whatever it is, depending on how big a company is. What was the beginning cash again? 33.
Okay, yeah,
What's and how much is the ending?
Really 32,000 on crazy market wrong.
32 you wrote in the market run.
I wrote 33. You marked it wrong.
Oh, that's
For
pretty.
beginning cash.
I don't know why I did that. That's half a point too. Yeah. So if you have any more, let me know. Yeah, half a point. I don't know if I bother. Okay, so first mistake I ever made.
First one I'm caught.
Yeah. Okay. Anyway, so how many points do we already have? Quite a few, right?
Yeah.
Those are a half point for every single one of those things you wrote down, including the operations, investing, and financing. So, write stuff down. Okay. Anyway, so now what? Go through any order you want.
Under operations, I think we should do, or write out change in current assets and change in.
You want to do that first? Leave some room for all the other stuff that goes above, huh? So you want to do the changes in current assets, I don't care, and the changes in current liabilities? I kind of like that strategy because what if you ran out of time? There's a lot of points coming, right? So why not? You know what you're doing. So what are you going to do? Current assets other than cash. By the way, put a check mark next to cash, right, everybody? Put a check mark next to cash because you wrote cash down. I actually had a couple of people on the quiz write cash down in 2 places. And, come on. Okay, so what's your current assets?
Receivable, inventory, fixed expenses.
Yeah, it's all 3 of those. They're even listed as current assets. Isn't that nice? Most balance sheets would, wouldn't they? If I don't, who cares, right? We'll be able to figure it out. You know which ones are which. You guys have a lot of knowledge now. So what are you going to do? What happens to accounts receivable? So you can draw arrows in real life, of course. You can say increase, right? Increase in accounts receivable. It abbreviates that. How much you go up by? So you did not collect a bunch of your sales. So what do you think happened to cash? Less than your netting shows, right? That's what amounts to. I didn't receive all the cash, but my revenues this is I bought inventory, right? You say that, you know, I know it's on accounts payable, we'll do accounts payable and liabilities, that's fine. Okay, so really I had cost of goods sold that didn't use any cash, right? So, yeah, anyway, yeah. Okay, so anyway, my cash flows are too high, let's look at that. Okay, but if it went up by, how much was it, 54? So if it went up, I must have bought it with cash, the way you could think about it, right? Okay. Bought more than I sold. Okay, then what? Prepaid, up or down? What'd you pay it with? Paid for them with cash. But if they went down, what happened? I used them and did not replace them. So I have expenses that didn't use any cash. So you just pretend you sold them for cash, right? So what do you have? 8,000 more than if you had replaced them. Think about it that way, huh? Okay. Go on the other one. Is that all the current, well, put check marks. Is that all the current assets?
Yeah.
Next to each one of them, okay? So you never go back, right? Getting the idea that you're kind of disciplined on that? Really help you. I think. Current liabilities, I got two of them, don't they?
Yeah.
What happened to accounts payable?
Increase.
What does that mean? Borrowed money? Yeah, so 45,000. I have more cash for to pay my bills. That's true. Right? Accrued liabilities? Decrease? What'd you pay them off with?
Cash.
Cash. So if I have less cash flow. Decrease the current liability. Right? Debit to it, that's credit cash. What's that, 7,000? What else do we have? Check off those two. What do you want to work on next? What are you going to take forever?
Total liabilities, like bonds payable.
You can use bonds payable if you want. Want to go on down those? It's okay. We can do bonds payable next. What happened to bonds payable? Let's see. It went up by 100, right? Does it say anything down below about bonds? No. So I guess we'd assume that only one thing happened. What's that if it went up? Well, you didn't invest in them. You were borrowing money. Issued them, right? You know, otherwise it'd be up under held to maturity investments, right? Or something. I mean, long-term investment bonds or something. Okay, so what they did then is they got 100,000 increase in bonds payable. So what would that be? Debit, cash, credit bonds payable? Now it could be that they issued 200,000 and paid back 100. I'd show both of them, right, guys? I show 200 cash coming in and 100 cash going out if they did that. Okay, but I don't know what really happened. It looks to me like they only issued. So where do you put it?
Finance.
Yeah, because it's non-current. That's where the financing comes from. Long-term debt and from equity. Excellent. All right. Why do the current assets and current liabilities go into operation? Because that's why we have them. Right? Common sense now, isn't it? So you don't have to think too much about where things go. They go where they logically go. Okay? Once you understand. So issue bonds payable. Right? How much do we issue them for? It's like 100,000. Brackets around it or not?
No.
It's debit, cash, credit, bonds payable, no bracket. Got it. Okay, good. So we can check that one off. You want to do deferred income tax while we're down there? Okay. Now what happened there? What must be the case with deferred income tax? Let's think this through a little bit. Did it go up or down? It's a liability, isn't it? So what did you do? Credited deferred income tax payable. For how much? 3?
Yeah.
Okay. What else? What did you debit when you did that? It's taxes. Income tax what? Expense. See where it says less income taxes in the income statement? That's income tax expense. How much was income tax expense? 30. So my expense is 30 on my income statement, but I am going to pay 3 of it long term, right? 3 of it is deferred until later. Deferred, put off. So how much did I pay now? 27. That'd be credit tax currently payable, maybe, tax payable. But then what do you do with the tax payable? What must they have done? Because there's no current liability tax payable. They must have debited the payable and credited cash, right? So the net effect is that came out of cash. Oh, only 27 cash went out, but I have expense on my income statement of 30, so what do you think? 3 is long-term borrowing, so I would buy it if you put it under financing, but most people would not do that. They put it where the offer does, which is where? They're going to put the net income here, and then they're going to add back the increase in deferred income tax payable. It's a decrease, what would that mean? I paid out more cash, right? Because if it decreases, I debit tax expense, say for 30, debit deferred income tax payable for 3, and I have to credit cash for 33, wouldn't I? I'd have more going out than the expense. So increase in deferred income tax means I have what? More cash than the income statement implies, right? My income's too low by that 3 from a cash standpoint. Got it? So it's not that generating cash, it's just difference, okay? Okay, so now you can check off deferred income tax. You want to keep going on equity? I don't care.
Sure, you can do stock or common
Yeah.
stock.
What happened to common stock?
Issued it. You just issued it.
Really? I think it looks like it went down.
Down
5 yes.
by 5,000.
Must be debited for 5. Look at Part D down there. What happened?
You retired funds.
You retired. How much did you retire? 5.
5,000.
So what'd you do? Debit common stock and credit? Got it. I gave up the cash. Right? You guys agree with that? That's what happened. That's what it says, isn't it? So where would you put that? I'm doing business with my equity holders. Financing, yeah. Okay, retire. Common stock. 5. Cash in or out? Credit, so. Good. Good, great. That makes sense, doesn't it? You can check that one out. You want to do retained earnings while we're there?
Yeah.
Okay, what do you know about retained earnings? I think I'd use a T for this one because there could be several things, huh? What do you know? Yeah, went up by 42. I think I'd actually write it down. Let's see what's going on here. Don't have to. Went up by 42, so you know that's the net of what? How much they paid and what dividends they paid, right? So it looks like they had at least 42 of income, doesn't it, you guys? Good. So the net income is going to be added to this, but what's going to be taken out maybe if they have any? Yes. Remember when that was difficult? Now it's just logical, isn't it? Retained earnings represents the accumulated wealth of the owners from earning. If they make more, add it. If they lose, take it out, right? Credit if you add it, debit if you reduce it. If they pay a dividend to themselves, what do? Reduce the equity. Reduce retained earnings with a debit, right? But we know it's a net income. Why? Because it went up. Okay? Went up by 42. So do I know anything else? I know what the net income is, right? What's the net income? Income statement. 70. So, see, when I do this, I am taking all the revenues and all the expenses, so we don't have to worry about those, right? We already got it. You don't have to put the income statement on again. Some students did that. They took a whole bunch of expenses and threw them on the cash flow statement. Don't do that in revenues. With net income represents the whole thing. Now, that would have made it 220, so what must have happened? They must have paid a dividend. How much did they pay? Difference between 220 and 192 is how much? 28. Now, they told you that. Did they have to? Of course not. You could have calculated the 28 dividend. You could have calculated net income of 70. I love problems where you don't have to actually do something like that. It's relaxing to get that. If I knew any 3 of those 4 numbers, could I calculate the 4th? Of course, right? And we'll do that on the final lot. We did it in test 1 through 4. All right, so what do you want to put on your cash flow statement? This is transactions with owners and from operations. What's from operations? The net income. So where do you put that? First under operations. So would you guys agree that if nothing else changed, if I make money, have positive income, I'd have more cash? No other account changes, of course you would, right? So we're putting that in there for that reason. I think we have more cash, we have income. What if you had a loss? Let's practice around it. we have less cash, we have loss. Okay, dividends? Yes, dividends declared. These are actually paid too, but you can just say declared if you want. How do I know they're paid? There's no dividend payable, they must be paid, right? Otherwise it'd be a dividend payable. So how much is that? 28, and what would that be? Debit retained earnings and credit cash, right? So you gotta have a credit balance for that, right? I'm sorry, you have to reduction of cash for that. Make sense? Less cash. And you actually paid them with cash too, of course. Okay? Now you can check off retained earnings. Don't put the change in retained earnings down too, okay? You already did it. Don't do it twice. Put a check mark next to that. What'd you leave? Investments, plant and equipment. What happened to investments?
Well, you get a gain on sale.
Oh, it has a gain on where? You see that? I see a gain on investments, a loss on sale of equipment and income statement, don't you?
Yeah.
Yeah. And then also down below it says what? Equipment that cost, whoops, investments with an original cost of 30, were sold for 50.
Yeah, that's a gain.
Looks like a gain of 20 to me, doesn't it, you?
Yeah.
What would be the journal entry for that? Debit, cash, how much?
50.
50. You credit what? The investment account for how much? 30, and that's how much came out of the investment account too. That's how much we're explaining, right? And gain, yes, gain on sale of 20. Now, it's not that this gain on sale of 20 is a negative cash flow or something. What we want to do is we want to show the whole 50 cash where? It's investment, non-current, under investing activities. So I want to show sale of investments up here, don't I? How much?
50.
50, and that's cash coming in, certainly, right?
Mm-hmm.
Debit 50, good. All right, but all I want to show is the 30 change to the account on my statement, right? So what do I have to do? Right now, I've got 50 here, and I've also got 20 on the income statement, including that 70 net income is 20, right?
Yeah.
Of that 50, I don't want to double count. What do I need to do? Take it out, okay? Subtract it out of here, 20,000. How come I put thousands on one side with no zeros on the other? Because I have horrible sloppy form here. I guess we should do one or the other, don't you think, guys?
Yeah.
All right.
Commit to it.
Yeah. Stick with your commitments. All right. Anyway, that's better. All right. So now, what else do I need to do here? I've got the 50. I've got the 20. Oh, I didn't write it down. Okay, we're gonna deduct. And we'd say the gain on what it was. Okay. Gain on sale of investments. What else do we have?
Equipment, plant and equipment.
Plant and equipment. So, and that's all we have left, right?
Yeah.
So if we do plant and equipment, we should have the whole statement done, because you put check marks next to everything. If you discipline yourself to put that check mark down there, it's going to make it so easy. You won't be flailing around wasting time, okay? And at work, that's true too, right? If stuff a little organized, it really pays off. You know, I've said that for 37 years, and I'm still totally disorganized. 40 years, gosh, 40-some years. It's too late to be organized, I guess. Okay, what are the accounts we're working with?
Plant equipment.
Depreciation.
Plant and equipment. Accumulated depreciation. Okay. What do I know about it?
Started off at 750,000 plant equipment.
Okay. Ended up with
860.
Would you guys agree they bought at least 110?
Mm-hmm.
But they might have sold some, right? Because it went up by 110.
Yeah.
What do you know about accumulated depreciation?
Started at about 60.
These are kind of old assets, huh? 750 cost, 560 depreciated. They're 2/3 depreciated, aren't they? Got the idea? Okay.
Mm-hmm.
What's the ending of accumulated depreciation?
650.
Okay. All right. So how much was the depreciation expense at the very least? Looks like it was 90 at least, right? Went from 560 up to 650. But if they retired some, the retired ones are going to come out of here, right? The purchased ones are going to be here, The depreciation is going to be over here, right? We know those entries, right? When you buy plant and equipment, don't you debit plant and equipment? Of course. And if we assume everything's cash, you credit cash. In real life, it might be a mortgage or something. We put it at the bottom of the statement, non-cash transactions, major ones, and then we just show the cash flow of the statement. That's fine. For our purposes, that's just fine. What else do we have? Depreciation over here is what? Debit depreciation expense, credit what? Accumulated depreciation. You guys know these entries. Okay. And then what's the other piece we have? I think they're going to sell some, don't you? Does it say down at the bottom they sold some?
Yeah.
Yeah, equipment cost of 90, in which there was 40 accumulated depreciation was sold for 44. Isn't that going to be a debit to cash? How much was it? 44,000, right? And then it cost how much? 90. So aren't you going to take plant and equipment out at 90? Here you are. And then there's accumulated depreciation. Oh, we better get rid of that or we have a negative asset, right? Because including the accumulated depreciation here, right, including that 560 is that 40,000 of accumulated depreciation. If you get rid of the asset, you better get rid of the accumulated depreciation, don't you think? Or you got a negative asset. So debit accumulated depreciation, how much? 40. Okay, that's 84, and plant and equipment's 90. Guess what else we have? We need a debit of 4, don't we? Or 6, I'm sorry. What's the debit of 6 going to go to? Look at that income statement. What does it say?
It's a loss.
Loss on sale. We have a loss on that one, don't we? Got it? We got everything, don't we? But that loss is already in the income statement, isn't it? And I don't want to show the loss twice. The loss is on the income statement, and the cash is only 44. How much did the account change by between those two? Let's post it in here. Accumulated depreciation gets debited for 40, right? That's that one. And equipment, plant equipment gets credited for 90. What's the difference between those two? 50? You guys agree with that? 50, that's what we're explaining right now. We're going to explain that 50. So what do I want to do? Where do I want to put the cash? What I just sell. Plant and equipment, which is a investment, non-current asset, so it's investing. Sale. Was it equipment or plant or both? Is that equipment? So I have sale of equipment. You could say a sale of equipment. I don't care. How much do we sell it for? 44,000. Does that explain the 50,000 change in the account? No, right? See the account changes 50, right, guys? Do you see that? Credit, debit 40, credit 90, right? We only put in 44. What do we need? Add the loss. You add the 6 back. You don't want to count it twice, right? You don't want the loss twice. Okay. I want the loss to be reflected over here, right? Not over here. So I'm going to add the loss back. Add loss on sale of equipment, right? 6,000. Good. Now what else do we have to do? So that you see that 6 plus the 44 is the 50 change in the account. We're good, aren't we? We're brilliant. Okay. So now what? What else do we have? Oh, we might have bought some plant and equipment. What did we start at? We ended up at 860, went up by 110, but they took 90 out. How much did they add? 200. Yeah. Brain sucker. Yeah, okay. That's right, isn't it? 200? Debit plant and equipment, 200. And credit cash, 200. Look at how much cash went out. 200. Where do you want to put it? Plant and equipment, non-current asset. Where does it go, everybody? And this time it's cash out, purchase. And I'd say plant and equipment on this one because it doesn't say what they bought, right? So I do both. I don't know which one it was. Land, building, and equipment, that's okay. 210,000. More cash or less if I credited cash? Less. Right? Oh, just 200 because I want to miss the problem. Because that's how my old brain works. Okay, anyway, 200. Got it? Then what?
you said I'd appreciate
Oh, I
it.
need something over here now, don't I? I got this one done. I got this one done here, right? Both those are gone. I need this one, don't I? Okay, so how much is it? Let's see, 560, and then we debited it for 40, so that made it 520, and somehow I got up to 650. What happened? What was your depreciation? Guys, the account went up by 90, and you took 40 out of it. How much did you add to it? Yeah, you guys scare me. Okay, anyway, yeah. You actually used to, that's trying to pricing that stuff, because you're doing something. Yeah. You guys have calculators in grade school?
Yeah, but like, more like even.
Oh, okay, good. Even then, you lose it, and start using it.
Like, oh.
And we do use them, but God, it's nice to be able to do simple numbers. It really is. But it's not. Obviously, if I was worried about it, I'd use a calculator. No.
I feel like once you start learning more complex math, you start to get a little bit worse at it.
I think so. Yeah, and everything's that way. I used to tell people, and still do really, that if you guys were to go to work and I were to go to work, let's say you're graduating with an accounting degree, and we were to both go to work for a CPA firm, who would be better doing the work? Entry-level stuff? You guys. Because I'd be so bored, so, oh God, I don't want to do this. You'd be all excited and pumped up, and, making money and learning to do stuff, and I just, oh geez, I can't do this stuff. So I'm good for sitting around bullshitting with people at meetings. I'm not any good for actually doing something. So, you've noticed that about me, right? Yeah. All right, so what do we do now? We got to get that 130 on. Now, it's not that this generated any cash, it's that it didn't use any. Including your income statement, you can't see the number, but in cost of goods sold, there's some of the depreciation expense, right? Because it went into inventory, manufacturing depreciation went into the inventory, and also down under operating expenses, there's probably some depreciation. So it doesn't have to show separate, it's in there, right? So if the expenses on the income statement, what happens? That lowers your net income, but it didn't use any cash. So what do? We add back the depreciation. Does that make sense? Not just memorize, but does it make sense? If you have an expense in the income statement that uses no cash, you need to add it back to get the cash flow, right? So let's add depreciation expense. And we got it, you guys. How do I know we have them all? You're going to check off the last account, huh? Yeah, how much was it? Can't remember. So I'm going to add that back. Okay, let's see if it worked. Now what might happen to you, this is going to be total cash flow from what? Operations. This one up here is going to be total cash flow from investing activity. And this one down here is going to be total cash flow from what? Financing. Okay, can you get those? And then what do we want to do? We want to make sure it all adds up to 18,000 negative. And the most common thing that happens is you'll have a reduction of cash with no brackets around it, right? Or an increase in cash with brackets around it. You go the opposite direction. Get your debits and credits and things like that. But if not, it should fall right out. Then yeah, you could do transpositions. You could be like me and write down some number that came out of thin air, I guess. Do that. We did that pretty quick, you guys. We're talking about it. Could have written it.
mistake though.
Something wrong?
Yeah.
How much we off?
Depreciation. I don't think we used the right expenses when I was doing it.
Well, it's not 130?
No, I got
Oh.
50,000 for it.
Oh, wait a minute. What's 130?
130 was, so I was looking at it and it sounded wrong. 130 was, the difference between net plant and equipment, where it's less accumulated depreciation. The beginning value in 2001 was 190,000, and in 2002 was 210,000.
Oh, these are not the right numbers.
Yeah.
Oh, that would screw us up. Gotta stop trusting you guys. That would mess us up, wouldn't it? Big time. So we're off a lot, aren't we?
Yeah.
Yeah.
That was off a
Good
lot.
man. But you can find it even if you make a ridiculous error like we just did, huh? So what was the beginning accumulated depreciation?
The beginning, 190,
Okay, and the ending?
210.
So what happened was we took the totals instead of taking the depreciation,
Yeah,
didn't
we
we?
took the net.
Yeah, all right, that won't work. Because that includes this stuff, doesn't it, with it? Okay, so now what do we know? That would have been 190 less 40 is 150, it's up to 210, what is it? 60. Yeah, I was just looking at this and I thought that depreciation looked right to me, but
I
you
looked at it
know.
and I looked at my quiz. That like my one that I actually did, and I was like, that seems a little high.
So what do we have? Depreciation expense is 60. So then if we use 60, the correct number over here.
Yeah, it all works out then.
Now everything's good?
Yeah.
Okay. So I guess the message is let's be careful. Okay. So what'd you get for each of these?
For operations, I got 21,000.
Okay.
For investments, I got 106,000.
But it's negative.
Yeah, negative. And financing, I got 67,000.
We shouldn't have double underlined those. That one I don't like it. 100 or 67,000.
Yeah, for financing.
So then what you would do is you take the 21, subtract 106, add 67, make sure that is negative 18, is it? Good. That work out?
Yeah, okay.
What else do we want to do? We can do some more of these, or we can do some from the summer one, I don't care. Since we did all of the other quiz between the 3 sessions we've had so far, we did the bonds, yeah, we did 2 of them today, and we did the bond during the day today. We just did those. See, you want to do number 1 and 2 from 1, 2, and 3 from the same quiz? Back to those. Is that worthwhile?
I have a quick question.
Yeah.
Could we go over, I know this is on the last quiz, but could we go over like the cumulative non-participating and the non-cumulative non-participating? Those 2 weren't on the quiz.
Oh, okay, sure. Participating and non-participating. Let me make up an example while we're okay. That's fine. That's great.
Because I know over like the last quiz we did go over like the non-cumulative and participating, but we
did.
just didn't go over those.
Yeah, I didn't put it on the quiz, did I? Yeah. Okay, so let's have some common stock, okay? Let's have some preferred stock. And let's say our common stock has a $1 par. And our preferred stock has a $100 par. And let's say outstanding, which is what you've issued less any treasury stock, right? Outstanding. I have 1 million shares. And outstanding here, I have 1,000 shares. got 900,000 shares of outstanding dollar par, right, common stock, and I have 1,000 shares outstanding of 100,000, or of $100 par. So the total par, obviously, is well, what is the total par? We could do that. What's the total par for each of these? Total par value, how much? 900,000 times $1. You guys agree?
The other one's
900,000 at $1. Okay. And then what's this one going to be? Total par.
100,000.
It's going to be 100,000 times 1,000 or 100,000. So if I add the two together, guess what? That's why I did that. Right? I get 1 million. And what percentage is each of the total? Because we're going to use that to share if we participate. 10%, 90%. That was 90. 10%, because the whole's 100%, right? You guys with me on that? No big deal. Okay. All right, and then let's say that the preferred stock pays a 6% dividend every year. Okay? You got it? So what's going to happen? First, no matter what kind of stock it is, right? The preferred stock is going to get, whether it's cumulative or not, and whether it's participating or not, right? The preferred stock is going to get what? $6 a share on 1,000 shares. They are going to get what? The first $6,000? And then if there are dividends and arrears, they're going to get $6,000 for each year, aren't they? Okay? Now then after that, the common shareholders get a matching dividend. So let's say the matching for the common stock, if it is participating, let's say the matching is, I don't know, 50 cents per share. Well, how much is that going to be if they match? There's 900,000 shares at 50 cents. What's that going to be? Up to 450,000 for them, right? Okay? That's the max that they could get as a matching dividend. You guys agree with that? Because, it's 50 cents a share and there's 900,000 shares. Okay? So I've got 450,000 there. I've got 6,000 here, plus any dividends and arrears if there are any, right? And then after that, they're going to participate based on what? Usually the relative par values. Not always. It can be anything you want. But we're going to share based on relative par values. So this will be the third thing. So first comes this one, right? If it's participating, second would be this one, right? And then third would be this one. If it's not participating, it's just cumulative, what do you do? Just give the preferred shareholders theirs and everything else goes to common. What if it's non-cumulative, non-participating? Give them $6,000 for the preferred and everything else goes to common. Got it? Okay, so let's say that we have, let's just pick a number here. Let's say that we have $500,000 in dividends. There's one. So we should do that one. Number two, the dividend is $200,000. Number three, the dividend is $15,000. Okay? But I want you to do it as those three, 4 different ways. A nice exercise. Okay? So so we're going to do all 3 of these, right? These 4 different ways. One is, and let's say they have no dividends for 3 years plus the current year. So 4 years, you got it? So their dividends and arrears are 3 years, and then they have the current year too. So how much dividend are you going to give them? 4 years, okay? That makes sense?
So, but then say it was like excluding current year, then it would just be 3 years.
No, if it's 3 years excluding the current year, it would be this. If it's 3 years including the current year, then it's total 3.
Oh.
Right? Excluding would be out, including at the end. I know you know that, but right? Yeah, okay. Were we there? Okay, it's easy to get confused on this, really easy. Let's do non-cumulative, non-participating first. And do all three of those. You'll be surprised how fast you can do this. Okay, so do that. What did the preferred shows get? What did the common shows get? You do it three ways. Okay, and then B is going to be, let's do cumulative, non-participating. Actually, we're going to have to go to another page anyway to do it. C is going to be predictable, non-cumulative, participating. It would be fun if I gave you this. Okay, and then let's do D, cumulative participant. You can do these, you can really handle this stuff. So give that a shot. Give that a shot. Do A, B, C, D. Do number 1 and then do A, B, C, D. Then do number 2 and see how it changes. And then do 3 and see how it changes. Okay? That's the way I do it. So set up a section, right, for this one with those 4. And do another one. And do another. Ready to go? Doesn't have to be neither. Tell me what it is. What that was there. Okay, there we go. Page there. Okay. So let's do A here, or let's do 500,000 first. Okay, 500,000. Okay, so my dividend's 500,000. Let's do part A. Non-cumulative, non-participating, right? This one's easy. What happens? We do the preferred stock, the common stock. They have to add, whoops, yes, yeah. They have to add up to what? The total. Okay. What's the total dividend? 500,000. And what do we know?
First stock,
Preferred stock is how much?
600,
First 6 grand. What are you going to give to the common shareholders?
the rest, so
And
490.
494 grand. You get it all, right? What if I want it per share? That's in total. What if I want it per share? Divide the shares in. How many shares did we have? 900,000. Or rather 1,000, I'm sorry, on the preferred stock. So that's $6, of course, because it's $6 per share. Okay, and then what do the common shareholders get? 494 divided by 900,000 shares. What's that? About 50 cents. How much?
54 cents.
54 cents. Something. Yeah. Okay, got it? Nothing too much. Okay. You want to keep doing those for all of them? Could have done it that way. I suggest you do it the other way. Let's go ahead and do it. Let's do what B would have been. Okay? Or 2 would have been. Let's do 2. Okay? 2 parts. shareholders get? The first what?
Yeah.
6,000.
There, there.
$6, right? What would common shareholders get, right? What was the total this time? 200,000, right? The second one there. So what do they get? 194? This is a joke, isn't it? 194 divided by what? 900,000. How much is that? I guess I didn't say in my problem I wanted per share, but what? 22 cents. Got it. Okay, let's do 3. What would it be? Preferred shareholders get what? 6,000. They get the first 6. That's it. Okay, that's $6, isn't it? What would the common shareholders get? Everything else. What's the total? 15, right? So they get 9. What would they get per share? Not much. What is it? 9,000 divided by 900,000. 1 cent per share. Got it? There's nothing to this, is there? Okay, good, good. All right. So then, this is a good one to ask about though, because I didn't have it on the test, did I? Okay, let's do cumulative non-participating. Okay, or B. What changes there? B1. Okay, I got 500,000 total. So what we're going to do is we're going to give the preferred shareholders theirs, then the common shareholders, then we're going to share if there's sharing, because there's no participation, so there's not going to be any sharing, is there? Okay, and then we have the total. So this time, what do the preferred shareholders get? Current year plus 3 years in arrears is 4 times 6,000, so 24,000 now? Everybody good? That's it, isn't it? So the first 24,000, what's that going to be per share? $6 a share times 4, $24, right? The total was 500,000, so who gets everything else? Common shareholders, what's that? 476, very good, right? Divide that by 900,000 and we find out what it is per share. A little over 50 cents. Because the preferred are taking more, the common are getting less, obviously.
Yeah, it's like 53 cents.
53 cents, so they lost a penny a share, didn't they? Got the idea? By giving the preferred shareholders more. Let's do 2. Preferred stock first, common stock second. Okay. Total is how much this time? 200,000? Who gets the first 24? Because it's cumulative. This is cumulative non-participating in. It's part B there. Okay? We did A, now we're doing B. Okay? So preferred stock gets what? 24,000, because they're going to get the current year and 3 in arrears, right? That's $24. Okay, what's common stock going to be? Everything else, 176. Divide it by 900,000 shares, what do you get? About a quarter? 20 something?
Yeah, it's 20 times 4.
About 20 cents. Okay.
Okay, so are you dividing it to find the price per share? You're dividing it by total?
900,000 shares on the common stock, 1,000 shares of the
Oh,
preferred.
okay, so it's.
But we already know for the preferred, because we took 24 times 1,000 to get the 24,000. So we already know they're 24, right? On the common, you have to actually calculate. 900,000. Got it? How much it is for each share. So it was 476 divided by 900,000, and then it was 176 divided by 900,000. That sound good? Okay, good. 3. What do we do on 3? Preferred shareholders, we want to give them 24, but this one's not going to work, is it? How much total we have? 15,000. So the first 24 go to the preferred shareholders, but what do we give them? 15. What do you give the common shareholders? Nothing. See how they're preferred? Now what is it per share? 1,000 shares into 15,000 is $15. And you know what? They still have $9 dividends in arrears. So the next year they'll get the first $9 per share, right? And then they'll get their current year 6. You guys good? Because we couldn't give them all 4 years. We gave them, looks like, what, 2.5 years? Nothing here. That's easy, huh? Okay? Everybody stay with me? Yep. Okay, let's do the next one. Let's make it a little more complex. Let's do non-cumulative participating. 42 seconds. Okay, so with one, I've got preferred shareholders, what they're gonna get, common shareholders, what they're gonna get, and then we're gonna share, we're gonna participate, okay? And it'll still be the total. So what's the first thing that happens? Preferred shareholders get how much? Non-cumulative. How much do they get if it's non-cumulative? Just 1 year. Yes, 6,000. Very good. Okay, and then what happens? Then there's a matching dividend. How much was the matching dividend? It is going to be 450,000, isn't it? You guys agree with me? Right? We calculated it, 50 cents a share on 900,000 shares. So wow, that's big, isn't it? Now, how much have we allocated? 456,000. How much is there left to go? How much are they going to share? The remainder. So we got $500,000 here. And if it's $1 million, they'd share, you know, instead of, what is this going to be? 456 less 500 is how much? 44,000 they're going to share, is that right? Do those three add up to 500? So they're going to share this amount, aren't they? Right? What if it was $1 million? They'd get 544 to share between them. You guys good? So to the extent that they're over 456, they're going to share. Okay? How are they going to share? 10% for the preferred shareholders and 90% for the comp. Is that what it was? Was, right? So take 44,000 times 10% will be 4,400 for the preferred shareholders, right? That's their share. That's 10% of it. I just took the 10% minus the 44,000. What's 90% of the 44,000? Of course, it's the rest. 39.6, is that what that is? 39.6, is that right? You just make sure you got the total amount. Those two add up to 44, right? Okay. Add them together. 6 plus 4,400 is how much? 10,400 for the preferred shareholders, right? What do you get for the common? 450 plus 39.6 is 489.6. Is that what that is? Yeah. What do those two add up to? Let's hope. Better be the 500,000 or we screwed up our math. Right? So you know you did it right. What is it per share? How many shares are there of the preferred stock? 1,000. So what do they get per share? $10.40. Is that what that is? $10.40 per share. You guys agree with that?
Now, will you ask us to do this on the, like, get this in depth on the chart?
Oh, not that many of them. I'll give you one or two of them.
Okay.
Right? I'd probably just give you $1 amount of the dividend if I had to do all four.
Okay.
Or if I give you several dividend amounts, I'll have you only do two, maybe. Got the idea? But you'd be able to tell them all apart. You got it made. What's 489.6 divided by the number of shares? It's 900,000 shares, right? What's 489.6 divided by 500,000? 900,000. 489.6 divided by the 900,000 shares we have. What's that? About 50 cents. Good.
Yeah, about 50.
450 is 50, so it's 51%, 52%, is it? Cents, not percent. Cents.
Oh, yeah, 24.
Okay, 54 cents. Got it? Okay, let's try two. What would you do? Exactly the same thing, right? What do the preferred shareholders get first? 6,000. What do the common shareholders get as their matching dividend? 450,000. Uh-oh. It doesn't work. What's the total? Only 200. So guess what's going to happen? They cannot take their entire matching dividend. What do they get? Oh, that got easier, didn't it? There is no sharing going on because there's nothing left. Got it? So per share, $6, and what's 194 divided by 900,000? That's all you have to do. See ya. How many cents is that? 21 cents. Okay, good. Then let's do the third one. This could be easy. What do the preferred shareholders want? 6,000. What do the common shareholders? That's $6. What do the common shareholders want? 450. Well, they're not getting that. What's total available? The third one there. 15, right? So what do we have then? How much for the common shareholders? 6 less, netted with 15, right? There's only 9,000 left. And then we divide 900,000 in there and we get our 10 cents again, though. Right? So it didn't make any difference, did it? Okay? Are we good? So then, let's do, we have one left, right? D, cumulative participating. Let's give that a shot. Participating. I think that was the D over there. Very good. Are these the answers you guys had? Pretty much? There? Good. Okay, so we got preferred stock, common stock. We're going to participate maybe. Total. Okay, so this is 1. Right? So we've got what, $500,000 for splitting up? They're going to be able to share this time, aren't they? Okay. So first, the preferred shareholders get what? It's cumulative. 6,000, right, per year times 3 in arrears is 18 plus the current year is 24, right? Same as the last time. 24,000. Okay, they get that first. Okay, then the common shareholders, how much do they want? The matching, right? How much is that? They don't get any dividends or arrears for this
Can you
thing.
do 24,000 times 50 for the matching?
No, the matching is 900,000 shares at 50 cents a share.
Okay.
It's 50 cents for each of their shares, and they had 900,000 of them. So that's where I got my 450,000. It's just whatever the agreement says. Okay. So the common shareholders get a nice dividend, don't they? 450,000 goes to them. Okay. How much have we used? This time we've used 24,000 for the preferred shareholders, right? 450, so 474. What's left to share? 26,000. Is that right? How are we going to share it? 10% for the preferred because they have 10% of the total par, right? Remember what we did? We had 900,000 par for the common, 100,000 for the preferred, $1 million total, right? 90% was common and 10% was preferred. Okay, so it's going to be 10% for preferred shareholders and 90% for common. So all you do is you take your 26,000 and say, okay, 2,600, right? 10% of the 26 goes to them. Okay, and then 90% of the 26,000, which will be the rest, is going to be 23,400. Is that what that is? Okay, total's 26 we allocated, and we're done, aren't we? Add them up, and what do you have? 26.6. Yes, we do. 26.6 total, right? For common preferred shareholders, 473,400 for common shareholders, and that total, you bet, is what? 500,000. Ta-da! You're right in there. Okay, and what is that per share? 26.6 divided by 1,000 shares of preferred, right? $26.60. So they got some more for the participation, right? They were going to get 24, now they get 26.60. Okay, 473.4 divided by the 900,000 for the common stock. How much is that?
Um,
52 cents. Okay. Let's do 2. It's going to be easy, isn't it? Because we only have how much?
200.
Yeah. We're going to run out fast. Okay? Because that 450 matching. Preferred shareholders get what this time?
24.
Yeah. Instead of 6, they get 24, right? Because they have cumulative. So they're better off. And everything else goes to common because they're supposed to get a 450 matching and they can't. By the way, there's no dividends or arrears on matching, so if they don't get the matching, too bad. They don't. It doesn't add up year after year, right? So how much is this? 176. Ta-da. divide them in. Well, this one's $24 per share, of course, because we already knew that. Preferred stock. What's the common? 176 divided by 900,000. What do you get per share?
19 cents.
Yeah, we're rolling. Okay, let's do 3. What do we got there? Only 15,000. Well, guess what? Preferred shareholders get it all. And they're still going to have 9 in arrears, aren't they? And it's $15 a share because there's 1,000 shares. Common shareholders get nothing. Why? Because preferred shareholders get it all first. Okay? Total. 2,000. Zero. Let's quit.
Okay, one more
Enough.
thing, so how did you get to the 450?
Okay. We said, let's get back on just a single. Okay. We arbitrarily said we had 900,000 shares of common stock, right? And then we said after the preferred shareholders get their dividend, which is $6 a share, and if it's dividends in arrears, it's 6 for all the years, right? Then we give a matching dividend to the common shareholders before we give anything more in matching, or in sharing, right, in participating. See you, thanks for coming. Okay, that makes sense?
Yes.
So I arbitrarily said it's 50 cents a share on 900,000
so that's
shares.
given.
Given,
Oh.
you would not know.
Oh.
It has to be in the agreement.
Oh, okay.
Okay, whether it's cumulative or not is in the agreement. Whether it's participating or not is in the agreement.
Got it.
What the matching dividend is in the agreement. What the par values are is in the stock agreements. What the 6% dividend, right, on the preferred is in the agreement. Everything's in the agreement.
Okay.
That they're sharing relative par values.